I don't know. This is take two. This is take two right here. I think we're live now. So if you guys pick me up on here, let me know that you pick me up on here. I gave one of the greatest investing speeches of all time, and nobody got it because the camera was froze. So my bad on that. I was just actually talking about the review I did on Sven Carwin. Somebody in my subscriber group sent it to me via email and asked me to review it for them. So awesome. All right, Jake's got it. Cool. Thank you, Jake. Appreciate. Welcome to the group, man. Sorry about that. I'm kind of like a business that started in my garage. So you guys are going to have to live through some technical difficulties, but I'll stay on an extra 15 minutes, man, to answer all your guys' questions. I'm going to be super aggressive tonight. Fire your questions at me rapid fire, man. I want to make sure that I get you guys the answers. All right, cool. Golffish is on. Now we're logging. Sorry about that. So this is take two. No big deal. I'm not kidding. I just gave one of the greatest investing speeches of all time, and nobody saw it. So that's wonderful. That's okay. Let's see if I can reconstruct the message that we were talking about. That's cool. Hey, Rohan. Awesome, man. Every time I see Rohan on here, man, I think about buying silver, man. Me and him had a great discussion on the prospects of buying silver. That's probably one of my top investments right now. As a matter of fact, really cool. I may be doing a YouTube video actually on going through your pocket change. I went through my pocket change and separated all my 100% copper pennies. And I separated all my loose change, anything before 1964. Nickels are 40% silver, and quarters are 90% silver, and dimes as well. And it was awesome, man. I found a nickel from like 1937. It was awesome. So, oh, hey, Sarah, welcome to the group. Awesome. If you guys have questions, please shoot it my way. If you guys that are members of the Facebook group, I kicked over a video that I was asked to review on one of the channel creators that I've followed for quite some time. Very smart. But I was asked for my opinion on it, and I definitely have an opinion on it. There was definitely some things missed, and unfortunately, I don't want to see new investors watch that type of content and be misled off of the stock market. I got Brian in the group. I know the general rule of thumb is to pay off debt before investing. Wouldn't it be prudent to still max contributions in a Roth IRA? The time factor is what makes me think. That's an awesome question. I've addressed this on some of my videos before, but I'm glad you revisit this question. It's really important. I'm not one of those guys that sit there and tell you to struggle your entire life to pay off debt only at the expense of investing. I really would like to see you do both. I've carried some debt in my life, and the best way that I knew how to pay down that debt, especially credit card, was to overpay. I've never, ever paid any attention to a minimum credit card payment ever in my life. Never. If I had the money, I would make multiple payments. Everything's set up through online. So when I want to make a payment, I'll overpay. For folks that are struggling and don't actually have the money to overpay. Now, I'm not saying if you have a couple thousand or $4,000 or $5,000 in credit card debt to pay it off all at once. You know, that's a big lift for anybody, you know, but if you chunk it up a little bit and do, you know, $300, $400, $500 at a time, if you can, it's really going to get you caught up quick. That doesn't mean that you can't start an account. There's certain things that you can do to prepare to enter the stock market. It won't cost you anything. Starting the self-directed Roth IRA account for you as a single person, or if you've got a spouse, you start those accounts that cost you nothing. And it's amazing the psychological piece that you'll overcome by getting those accounts started. And then once you've aggressively got that debt under control, then you can go ahead and set aside, you know, $25. I say all the time in my group, I started with $25. That's why I don't mind recommending it to others, because it's not about the $25 when you start investing. It's about the mental mindset. It's about taking that $25 that you would spend elsewhere and paying yourself first, right? So over time, once you do that 25 a month, 25 a month, 25 a month, you're going to want to do that bi-monthly now. Now you're going to do 25 every 2 weeks, or you're going to beef it up to $50 a month, whatever. And then you're going to start to get your mind conditioned to live without that money. But that's a killer question. And I know, don't ask me a question and expect that I'm going to give you a politically correct answer. I will not do that. A lot of folks are talking about you got to eliminate debt before you even have the luxury of going into the stock market. Look, the folks I'm trying to talk to are hardworking, folks that are making, I assume that I'm able to talk to people that are making just about less than me. I make less than the median income in the US, but I'm sitting on over $250,000. How did I get there? I got there by not sitting on the sideline. Okay. Now I've had credit card debt in my past, right? I've dealt with it. So I'm not going to give you advice to sit there and say, focus on the debt, without acknowledging the importance of investing. I don't care. I don't care if you make $25,000 a year. I don't care if you make less than $20,000. I don't care. I don't care if you've got, $10,000 or $15,000 a year of income. If you can rub a couple nickels together, put that money away, put it to work. It's relative, guys. I know folks that make money like me that are really good at money. And I know guys that are making 6-7 figures and they blow it all. They're horrible with money. They're horrible. So it's relative. And I think, unfortunately, a lot of hardworking people out there get the mindset that they cannot do it. And I think some of those people that are the hardworking salt of the earth, blue collar folks, are probably some of the best suited to succeed in the stock market. They really are. They really are, because I think, unfortunately, in the stock market, there's a lot of people out there that fall victim to thinking that they can just beat the system over and over again. And hardworking Americans like myself, I don't have time. I really don't. I'm really interested in the stock market, and I do take time over and above an average individual. Honestly, I'm a dork. Seriously. I mean, if I was stuck on an island, the only channel I would want to watch is CNBC, because it provides me market impulse. Now, do I act on a lot of that market impulse? No, of course not. But I like to be engaged with the stock market. Does it affect my portfolio decisions every day? No, it doesn't. But I just like to be aware. I like to be aware of what's going on in the stock market. That's all. So go for it, Fish. Hit me up with the question. A good question that came up on the Facebook group today was your plan for your TSP after the military. Keep it in the TSP or roll it into your Roth IRA. Thoughts? Well, both are fantastic options. What I'm going to do is I'm going to build up both. And when I'm eligible, I'm going to roll the Roth TSP into my individual account. That's what I'm going to do. So if I've got, $500,000 over here, 750,000 over here, I'm going to combine the two accounts and just roll this in and make a super account. That way it'll assist with the compounding effect. That's it. That's my long-term plan. And a lot of people don't even know that they can do that. And the secret is knowing that you can do that. If you went to Edward Jones and you went to Citigroup, for example, a normal civilian cannot open 2 Roth IRA accounts. It doesn't work that way. Okay. But for you guys that have existing like Roth 401ks or Roth 403bs, certainly you want to start those individual accounts and also start the self-directed Roth IRA account. I always say do both and build them up over time. And it's never going to be a bad decision to, rely on keeping this account or keeping this account separate, or the eventual rolling one and the other, because they're like accounts. And that's exactly what I'm going to do, man. That's a really good question. A lot of people don't know that option exists. What I would contend with regard to anybody out there that's a military investor, you certainly need to know. And this also transcends the group. It really does. If you're out there and you're investing in a 401k, or you're in the military and you have a TSP, or you're a government worker and you're in the TSP, you need to know what you are invested in those accounts. I honestly think talking about what you could do down the road is probably less important than looking at what you have today. Know exactly what you have today. Know what your contributions levels are. Know what funds you're invested in, and then forget it. All right. And if a lot of people can get there and be more aware of what they have, they're going to win the battle long term. No doubt about it. Thank you for the question. That's awesome. Fantastic. If one focuses on the debt, you lose the compounding interest over time. Yeah, I agree. I agree. And look, it's contrary to what some folks may tell you. You know, some folks are going to tell you, "Oh, I've got to stay close to the vest. I don't want to hurt this person." And I just don't BS people. I really don't. I'm going to tell you what's worked for me. I've carried debt in my life, and it's only problematic when it consumes you. Okay, it's only problematic when it starts to consume you, guys. All right. Now, money can solve all problems with regard to investing and with regard to dealing with debt, right? But you're sure as heck not going to tell me to just focus on paying it off debt with the expense or the excuse of avoiding investing. No way. No way. I believe it should be a requirement, just like freaking auto insurance, to invest in the stock market. That's how accessible I want to make this to people. Because the only way blue collar people, hardworking people, people out there who are running this country are going to participate in this country is to inject some percentage of your net worth into the stock market. That's it. That's it. And whatever percentage you guys feel comfortable with, if you've got a stockpile, if you're got a little bit of debt, but you got a little bit of stockpile of money, start this account over here. But make sure that the pendulum is balanced. Make sure that that debt isn't consuming you over here, you know, with a 15% negative interest rate, and you're working really, really hard, or I'm really working hard for you to try to get that 7% interest, right, to help on the compounding interest going forward. Because like I said at the beginning of the show, that none of you guys saw when I was talking about compounding interest, unfortunately, the example of what most people see on the effects of compounding interest are when they hold a credit card and it starts to drive them and pulverize them into the ground, into a vacuum on the negative side of the house, right? It's a lot easier to drive that compounding interest into the ground on the negative side, as opposed to acknowledge that if we can struggle to get to that positive side, we can start the compounding effect on the positive side of the house, right? So awesome question. I really, really appreciate it. Good morning. I'm from the Philippines and a small investor. I started small myself, so good to have you on board. My long-term plan is to buy stocks every month in 2 blue chip companies. Is my plan okay? I think it's okay. What I would really, and I hate to be cliche with my message, I'll try to speak as plainly as I can if there's a delay in the feed, if you're all the way over in the Philippines. But passive investing is the best way to invest, okay? If you could invest in one share of the VTI, okay? It's the Vanguard Total Index ETF. Trades under the ticker symbol VTI. If you have any brokerage account out there, you can own the Vanguard ETFs. It's no problem, okay? You do not have to have a Vanguard account. And what I would suggest that you do, if you're looking to get your feet wet in the stock market, it's either go with the VTI, which is the Vanguard Total Index, or the VOO, and that's the S&P 500. The show that you guys all missed because my live feed didn't come through at the beginning is I was talking about the historical rate of return of the S&P 500, guys. Since 1928, it has turned back 10%. 10% year-over-year value, okay? 10%. It's turned back 7% in real dollar amount, okay? Now, real dollar amount means that it accounts for inflation over that time, okay? But the S&P 500 is your nexus. And what that's going to do for you is it's going to diversify you right away, right? Okay, so if you're looking to pick single stocks every month, okay? I've seen this before where some of my subscribers have talked to me and they've got, you know, a bunch of stocks in their portfolio, but they only own 1 or 2 shares of each. What I'd like to see you do is buy the entire index, okay? Buy the entire S&P 500, and that way you get that broad-based diversification. Even if it's 1 share a month or it's a partial share per month, you're going to build that baseline the way I want to see it built. And I want to see you do that first. I really do, because here's the problem with stock picking. Stock picking is an aggressive way of investing, all right, even if it's blue chips, because here's the problem. You could screw up and buy Boeing at the wrong time and watch it go down 30%, right? Oh my goodness, because I picked the wrong stock over here. Oh my goodness, I didn't pick the stock over here. I didn't pick Home Depot. Home Depot went up 15%. I'm stuck over here with my 2 single stocks. If you buy the whole index like the VOO, you're buying everything. You're buying everything, okay? Now, a stock can only lose 100% of its value, okay? Once a stock has lost 100% of its value, it ceases to exist and will get revolved and rotated out of the S&P 500. But a company on the upside can gain thousands of percent. If you look at the historical rates of return of Amazon, Google, Facebook, Apple, some of our blue chips, J&J, Procter, right? Those rates of return are up into the hundreds and thousands of percents, right? So that's what you're participating in right away when you buy a total stock index or the VOO. And I encourage any new investor out there to not underestimate the power of buying that diversification right away. It might not make sense to you right away, okay? And I know everybody wants to go out there and just buy single stock. You will, and you will be given your opportunity to do that. But you have to set up that diversified base to start. Give yourself a chance to get used to being an investor in the stock market, all right? Give yourself a chance. Don't buy that single stock and have it adjust down 50%, and now you're turned off to the stock market forever. That's the last thing that I want to see, because there's so much reward to being a stock investor that I want you guys to savor those rewards, and I want you to understand and internalize the benefits of becoming an investor for yourself. I don't want you to be an investor because I told you to be an investor. No way, right? I had one of my Facebook groups. They were like, Ryan, thank you so much. I got into VOO. And I was like, yep, I own it. That's awesome. I love recommending, good ETF products, the best as far as I'm concerned. But I want you to understand why you do it for yourself. I want you to understand why you own the account that you do. I want you to understand the insurmountable benefits of driving all fees out of your investment portfolio altogether and how that's going to benefit you down the line. Guys, you have to understand. If you do not internalize it for yourself, it's not going to make any sense. And you're going to be stuck holding the bag, and you're going to wonder why you listen to the advice of a crazy YouTube guy. Okay? All right, cool. Let me get to some of these questions. My question is regarding 2 ETFs. VHT for healthcare and ITA for industrial to have on our portfolio. What's your take on it, as many folks don't talk about it, and these 2 ETFs have had good returns? Yeah, so Rohan hit me up with this last week, and I really wanted to address this. I still own the utilities ETF through Vanguard for the utilities. Now, that was to satisfy the 3% of total overall allocation in my portfolio. The problem is, and here's my example, if you start to buy ETFs that are specific to sectors, okay? Now, for you guys that don't understand, sectors are like technology, consumer staples, consumer discretionary, financials, healthcare. In this particular example, it's basically that you buy an ETF that covers just that sector, right? So if you just buy healthcare, for example, like Rohan's talking about in the group, you're going to buy everything J&J, Pfizer, Merck, and all of the above in that healthcare. The problem with investing that way, it's not quite as bad as single stock, okay? Because within single stock, you could buy J&J and Merck goes up, okay? That's single stock investing, and it's easy to miss out, and it's really hard to pick the one that goes up all the time. It's impossible, right? The ETF investing, when you're looking at sector-specific investing, can be just a higher degree of safety because you are diversified within that sector, right? But what if the sector is in a secular downturn, okay? What if you end up buying financials and you end up investing in and they go through a day like they had today, where the entire financial sector goes down, right? Or what if they go into a secular downturn? What if a piece of legislation comes out and the entire sector that you invest in, let's say technology, right? Let's say tariffs are imposed to negatively or adversely affect the technology sector. Now you hold that entire basket of that sector that goes down all at once, right? So it can be a good way of investing if you don't want to invest in single stock exposure. But I highly encourage you guys to use sector ETFs in a way that acknowledges that fundamental baseline of the entire index. That way, if staples outperform over here and industrials outperform over here, but financials and healthcare underperform over here, you own the entire index and you can participate in all of the appreciation and, yes, all of the depreciation in the stock market, but you're not missing anything. You're not missing anything. And you run more of a risk of a downturn if you're trying to pick sectors, okay? It's a little easier to pick sectors than it is to pick single stock. But again, if you end up on a secular downturn, like I've just been killed in VPU, you know, and I'm having to hold it long term because I won't sell a stock or an ETF in the red, right? I mean, I'm down 12% in VPU right now. It's still paying me a good 3% dividend. It's still giving me my 3% of utilities. But utilities are out of favor, right? So I'm getting punished for that, right? So I hope that answers your question, Rohan. It was a good one, and I'm sorry I didn't get back to you on that. You brought that up last week, and that was a really, really good point. But I really have kind of shifted my focus personally on having the majority of my holdings in as diversified of an asset that I can get. And then I add small strategic pieces to that portfolio or on top of that strategic base that I've got. And I'm really trying to avoid overexposing or putting dollars to work in one specific area of the stock market, because it almost seems like every single time you do that, you really get punished. You really get punished on that. All right. Are you investing? Okay, you guys are talking with each other there. Do you recommend for the TSP 70 in the C fund and then 20 in? So I've got S and I. That might be what you meant there. 20 in S. I hope that's what you meant. I'm hitting you up, Jake. Jake's one of my shipmates, actually, another military member. I do 70. 20 and 10, I believe, is what I do. So that's exactly what I do. I might do 15 and 15. I can't really remember, but the majority, I think it is about 75%. I might do 75 in the C fund and 20 and 15 in the S and 10, something like that, because I want that international exposure and I want that small cap exposure in the TSP. And it's my passive. I invest in it every month. I do 10% of my income to it, and I don't hardly look at it. I really don't. So hopefully that helps you, Jake. Oh, you're welcome, Goldfish. Philippine Stock Exchange not in the U.S. Yeah, I certainly wouldn't want to comment on your Philippine market. I know there's other subscribers in my group from the Philippines. No doubt about it. I don't know what you guys have available out there for investing. I'd certainly love to plug the entire world into the U.S. stock market, because that's one thing I got out of Sven's video that I got referenced on, is the historical returns on U.S. equities has been better than any other country, minus Australia. Australia was better, and there was one other country, but it was not a country that I would have invested in. So yeah, KYS is on here. Awesome. I got another channel creator on here. Awesome. I always give the shout out to the channel creators when they come on. So KYS, man, very loyal comments on all my videos, man. I really appreciate it. I really wish I had more time, which I don't. I don't have time to go and check out all the channels on YouTube that I support. Really the best I can do is just give you a shout out and support you in your mission. You know, hopefully this YouTube thing kind of pays off and we can all start money machines for ourselves. I really highly encourage you guys, and I'll be starting hopefully, if my channel, we just hit 3,000 subscribers on the channel, and shout out to everybody really who's new to the channel. No doubt. I don't apologize for the message, man. I congratulate you. If you found the Independent Investor channel, I do everything I'm talking about. Getting people empowered and investing on their own, man, is the goal of the channel. It has been from day one. So KY's hit me up and asked, as far as debt versus investing goes, it's really simple. If the interest you are getting on your investments is greater than the interest on the debt, then mathematically it makes more sense to continue investing. Yeah, it's kind of one way of looking at it. Certainly, I wouldn't want you to look at your debt over here and avoid it because you're getting a better interest rate, or the stock market's going crazy over here. Because as we all know, volatility can pick up over here and really start to fluctuate down. And one fundamental premise that I talk about in investing all the time, and you guys will pick this up as you listen to my catalog of videos, but I'm just going to address it now on a Friday night. I don't mix my static cash with my investing cash. I don't ever intermingle the two. Okay. I look at investment cash over here as my sleep easy money. Very, very rarely will I ever look to take that and put that to work in the stock market. I always try to keep my investing capital working over here, and very rarely do I ever mix those two, except for one time per year. And that is when I take my investing capital and I fund my accounts. I fund my accounts every single year, January 1, I fund the Roth IRAs. And that's just the way that I do it. And then I'll work to backfill my sleep easy money over here. But that's a really good point, KY. Honestly, man, whatever advice we can give folks to help, debt is not good. Okay. It's not going to be good for you. I'm an advocate of credit cards. I'm not one of those guys who think credit cards are evil. I'm not. I think credit cards, if used wisely, okay, no pun intended, if it's used wisely, it can really help you build your credit. For you guys that are in your, I get a lot of benefits through my point system, and anybody can get it as long as you're not paying an annual fee for your credit card, please, because you're paying an annual fee, you're getting the same service as me, and they're giving quite a few rewards for buying everyday things. So you might as well get credit for that and build your credit to boot. But you guys have to be very careful with the power of credit, okay? And you have to use it responsibly, and you have to use it for what it's meant for, okay? And you just have to be careful. You have to find that balance, and as your financial health and strength grows, you can get a little bit more aggressive over here, a little bit more aggressive over here, but it's a constant balance. It really is. Any international ETFs that you would recommend? Yes, I don't have the ticker symbol off. I think it's VEU, if I'm not mistaken. You guys can cross check me. But I do not deviate too much for Vanguard. There's no reason to deviate off of Vanguard's product listing. If you guys were interested in doing an international, now my VTI does have international exposure. It's the Vanguard's total index. But if you wanted like a European specific or an emerging market, you can go on Vanguard's website. I provide the links to all that stuff on my Facebook group. Guys, if you have not looked at the ETF page on Vanguard, you really don't need to look a whole lot further other than that product page. That suite of products on there for large cap ETFs, bond funds, small cap ETFs, it's all right there. It's all right there, okay? I just tend to really focus on the expense ratio, and I encourage you to do that because I can guarantee you that international fund that you pick off of the Vanguard website is probably not going to have as low of an expense ratio as I enjoy in the two accounts that I recommend, and that's the VTI and the VOO. All right, that's 0.04. Okay. 22 watching and only 7 likes. We need 22 likes. Oh yeah. Listen, you guys that know me, I don't really care too much about having 14 million subscribers on my channel. I could care less. For the people who are here and hearing the message, again, I won't apologize. No way. I could just as easily shut down this channel. No problem tomorrow. But the reason why I do this channel, quite frankly, is to help people. That's it. That's the only reason. It's to spread a message that I know everybody needs to hear. Now, not everybody really, not everybody's going to hear this message, okay? Not everybody. But if you were ever interested in taking control of your finances and putting it into a conduit that's going to plug you directly into the New York Stock Exchange, I'm the only one that talks about this stuff, guys. I'm the only one. You're not going to tune into the mainstream media. You're not going to go into Wells Fargo and they're going to freaking tell you, hey, this is the best route for you. Here you go. Here's a self-directed account for you. We're not going to make any money off of you. You're going to keep all the profits on your side. Nobody's going to do that. That's why you've got me. That's why I refuse to apologize to anybody. And I don't have a lot of tolerance for people who come in and try to bash the channel a little bit. I don't have any tolerance for it. I don't. Because a lot of people who have been watching me for a while know I'm a pretty freaking sincere guy, honestly. I don't do this for a living. I don't. I'm raw and uncut. I spend as much time as I need to aggressively get you guys this message. And that's ultimately the bottom line. That's all I care about. All I care about. Thanks for the likes. Now they're going up. Somebody prompted. I appreciate it. I think it helps me. I don't know. I probably get a fraction of a penny every time I get a like. I don't know. I'm not getting rich off YouTube, guys. Trust me. Don't worry about it. All right. Don't worry about helping a guy out. Don't worry. Hit the thumbs up button. I'll talk until I lose my voice. All right. How about that? Have you taken a look at Splunk? No, I have not. I'm sorry. I watch it go up every day. That's interesting. I don't know much about it. I'm sorry, Mike. I will get back to you on that. And I will throw that to the piranhas in the Facebook group. Let's see if we can't open up a discussion on Splunk and we'll do a review over it. Take a look. We'll put balance sheets on there. We'll take a look at her. I have not looked at it. I'm sorry. I have not done a lot of buying. I'm letting this stock market settle out. I believe the pulse of the stock market has kind of settled out. And I'm allowing things to kind of settle down a little bit. I'm monitoring the stock market right now. I haven't done a lot of moves. Have you ever read The Intelligent Investor? I have not. I know Ryan Scribner's big on The Intelligent Investor, but I have not read that one. I've read a lot of other investing books, but I have not done that one. I've had it heavily I'm not a big reader. I'm really not. I catch a lot of my news through news feed and things like that. You have to understand, I do a lot of reading at work, man. I read law. So it's not something that I do for freaking fun. I'd rather pick up a guitar. Okay. So, but thanks for the question, man. That's awesome. I will pick that book up. If anybody wants to send it to me for a thank you for doing the Independent Investor channel, man, that'd be awesome. I'll read it and then I'll do a YouTube video and I'll donate it to you, or I'll call you out on the video. That'd be cool. What is the income bracket for a Roth IRA? Yeah, so it's up to 114,000. 114,000, it gets reduced, and then it gets reduced in between 114 to 129. So if you're making over 129,000, you're going to be ineligible to contribute to the Roth IRA. And how is it different from the traditional IRA? Aren't we saving taxes on traditional too, in a way, as it does not count on our paycheck? So how is a Roth better than a traditional? One of the best questions I've got. Thank you, Rohan. You're firing on all cylinders tonight. That's awesome. Traditional allows you to take the tax benefit up front. A traditional IRA can be beneficial to you if you anticipate being in a lower tax bracket when you retire. Okay, what you are able to enjoy upfront in a traditional IRA is a reduction of the marginal tax rate. Okay, so it can be a big reduction. Any contribution that you make to a traditional account can be taken off of your taxable income upfront. Okay, upfront. And that can be a huge benefit, okay? Because if you take those tax savings and you roll them back into your investment account, which most people don't do that, all right, you can actually make out better than a Roth IRA, all right? Now, here's the catch. The catch in a traditional account is, remember that tax benefit that you've taken up front? The government is going to want their money, okay? Now, the benefit to you is that you're going to be taxed at the effective rate. So if you're taxed at the effective rate later on in life, it's going to be a wonderful benefit to you. Remember, you've taken the marginal tax rate up front, and then the effective tax rate down the line. So it can really be a beautiful thing. It can be a beautiful thing. Here's the kicker. There's no real guarantee of what the tax rates are going to be down the line in the future. I talked about the effective tax rate. Traditionally, it's significantly less than the marginal tax rate than you'll pay by taking a reduction on your taxable income year in and year out by contributing to a traditional account, right? The kicker is this. The government is going to want their money at some point, okay? Remember, you took the tax benefit up front. At 70 and a half, if you've had those accumulated dollars in there, yes, like you point out, they're growing and they're helping you and they're compounding over time. The problem is at 70 and a half, the government requires you to take a minimum required distribution on that traditional account, okay? So if you do live to 70 and a half, they're going to require you to take a minimum distribution, and then they will tax you on that amount because eventually the government is going to want their money back, okay? Now, what a Roth IRA does is it allows you to take post dollars. You're not going to get to reduce those contributions from you're basically deferring that benefit to the back end, okay? Now, the beautiful thing about the Roth is it does not have the required minimum distribution schedule. Furthermore, I have no idea what the tax brackets are going to be in the future, and I would rather have my guaranteed compounding interest that I'm putting away and accumulating over time be capped at zero. That's the benefit of the Roth IRA in summary. And you guys really probably should. I know you probably just listened to that spiel of mine for the last 3 minutes, and you're probably like, what? Okay, I've done research on the topic. So if you Google Roth versus traditional, you're going to get the same explanation that I just gave you. And I encourage you to do that. But both can be very beneficial. Read about a backdoor Roth. A backdoor Roth is where you take the benefit on the traditional side up front. And then around the midway point in your life, you actually start to take contributions from that and actually filter them into a Roth to take the benefit on the back end. That's called a backdoor Roth. You guys can read all about that stuff. Pretty cool stuff. All right. Fidelity has a reward card that you can use to fund your Roth. That's cool. That's really cool. I've heard nothing, Sarah, but good things about Fidelity. And that's one thing that I kind of rest on you guys. If you guys have, I just did a review with one of my colleagues at work on TD Ameritrade. Said it was really, really good. Some of my folks are with Vanguard. Some folks are with Fidelity. Some folks are with Ally Financial, M1 as well. I know Brent, he helps me a lot on the channel and the group. And I know they're happy. So if you guys are still happy with those brokers, certainly please let the group know. I know there's a lot of people out there that are curious to know what brokerage house everybody's with. And I think for the most part, it gives you a very similar product, you know, access to the market. Make sure that the account that you open is a self-directed account. But I think a lot of it comes down to aesthetics and the trading capability and the incentive benefits within each platform. So any one of them will get you done. But thank you for that information, Sarah. That's very cool. Ryan, do you recommend to have both VTI and VOO? No, I do not. That's a great question. I do own both, but one is in my spouse's account and one is in my account, okay? I already own the S&P 500 with my pension at work, okay? So I don't need another S&P 500. You only need one, all right? So I added the VTI to mine as a Vanguard Total Index, and then I added the VOO S&P 500 for my spouse. So that's the main holding in her account. Okay. So thank you for that question. Very cool. You guys are asking questions too fast here. Let me scroll back up again. I missed one from Victor. Victor, okay, I have a TSP, got it on a whim a few years ago. I went 15% Roth and 15 traditional. I thought the percent stands for your military pay. What confuses me is, are you guys investing all 100% of your pay? No. I invest 10% of my pay, Victor. I'm sorry if I wasn't clear on that. Only 10% of my pay. And then that 10% that gets allotted, I think it's right around $500 per month. So half of that, $250, goes in the midterm paycheck. And then at the end, for a total of $500 per month. And then those dollars, 70% of those dollars would go into the C, 15% into the S, and then 10% into the I fund. I think that's how it's broken down for me. But I think you're fine. I actually started with the traditional in my TSP account. That little dab is still in there, but the majority of my funds are all tax protected in the Roth TSP. So thank you, Victor, for that. That was very good. Agree with VTI and VOO recommendation. Thank you, Eric. Honestly, guys, you're going to win with those accounts. 0.04 expense ratio. I love that. What you guys didn't hear when at the beginning, because I was on fire and I gave my whole spiel, my investing spiel that you guys missed. But I don't care if you invest in stock A or stock B or ETF C, okay? I don't care if you own widgets in your investment account. Whatever is going to get you the 7% rate of return in the safest manner. That's all I care about, because 7% positive rate of return on an average is going to get it done for you. It's going to get it done. And if you take my advice and you put these assets, these best quality assets, in the right account that I'm talking about, so many people want to breeze over the type of account that you own. And it's a big, big mistake. Big. You should be so proud that you found this information. And for you guys that have actually started the self-directed account, over time, you're going to look back on this and you're going to be like, oh my goodness, I'm so glad I found that, because I'm able to set up a legacy for myself and my family, no doubt, because you're going to get to keep it all. You're going to get to keep it all. And so the only thing that I have to do, I feel like I've already succeeded in getting you the right account that's going to wealth preserve and tax protect your dollars going forward. I've already succeeded. Now, picking the right asset to put inside that bucket is the easy part. It really is. So you don't want to get too overzealous over here, doing the right things over here, starting the account, and then trying to pick stock over here and fill this up with a bunch of single stocks. That's not really the idea behind it. We want to try to achieve a 7% minimum rate of return year over year in that account. And that's where the compounding effect is going to happen for you. And if you're really good at picking stock, that's great. But what if you pick one bad one, right? What if you invest in a General Electric, at $35 a share, and it ends up going through this long downturn, right? I own General Electric, right? I tried to pick a bottom in it at $18, and I ended up being wrong. So you just got to be kind of careful. That's why I talk about just owning the index the whole way. To clarify a bit on my earlier comment, I don't mean the current year's return on the investment, but the historical average rule of thumb I use in interest on debt. 5% or less, I would continue to invest. That's awesome. Thank you, KWise. I'd like to have you make some money from YouTube. What would you like to do? Yeah, I think Ryan Scribner probably hit on this nerve probably the best out of anybody I've seen, honestly. He's really taken and scaled his business very well. I just refuse to do it. He respects my opinion, and I support him in any way I can. I love to see good people succeed, no doubt about it. I've made a little bit, but my intention actually is to take all my earnings and start a business account with the earnings, as small as that they may be. So I'm going to take that business account and I'm going to filter the earnings from YouTube. And hopefully, I don't need the money. So hopefully we can do some good things with the money. Guys, look, at the end of the freaking day, there's a lot of people out there that need help. All right. A lot of people who tune into my channel are aspiring to something better in life. And investing is not for everybody. There's people that are struggling to put freaking food on the table. All right. So for you guys that are tuning into my channel and trying to seek out a little bit better of a life for yourself, that's exactly what I'm trying to help you with, guys. But investing in and of itself is not a right. It's not a right. It's a luxury. All right. And you really need to not lose perspective over that. If you have the ability to invest, I insist that you have to invest. You have to, because a lot of people around the world, man, don't have that same opportunity. They don't. All right. Now I expect a guitar solo. Yeah, I wish I was better. Hell, I played for like 20 years and I'm still not that good. That's what's crazy about it. I don't know. I'm just not that musically inclined. But it does calm me down, and I do enjoy it. So yeah, for sure. If you're not making money moves, would you recommend holding cash and waiting, or going ahead and dropping coin on some ETFs? That's an awesome question, Brian. I always contend I don't put really a whole lot of value on cash over investments or investments over cash. I value them both. All right. And here's the funny difference between my perspective as an individual investor, as opposed to going and sitting down with a financial planner, right? And I say this all the time, man. If you go in there with $10,000, they're going to want it all. They don't care that you can feed them yourself. They don't care that you take half and invest it, and half, 5,000, goes over here and sleep easy money. I would say continue to build cash, but depending on the amount that we're talking, I mean, if we're talking about, let's say you've got 10 grand, what's holding you back from taking 2,000 of those dollars and putting it into VTI or VOO? Get a good S&P 500. Don't try to overthink the thing, man. Don't. I mean, this stock market may have just provided you a nice relief from the highs of the stock market to take an injection point. Now, I'm not saying that the stock market is going to go up or down from here. I don't know. I'm not investing right now because I have a lot of money riding in the stock market right now. And I just like to, I'm exercising my right to hold. That's all. That I'm right, wrong, or indifferent. That's what I'm doing. All right. But depending on the amount that you're talking about, Brian, and if you don't want to hit me up on this forum, hit me up in private and kind of let me know. I want to make sure that if you're talking about cash on the side, that you're talking about $1,000, or if you're talking about $100,000. Okay. It may change my approach and my answer for you, but my answer to you, just like my advice to anybody, is going to be, don't freaking wait. Okay. I have a lot of people who come to me and they're like, Ryan, I got to get invested in the stock market, man. And they'll talk to me and they're freaking fired up, right? They're fired up and they never do it. They never do it, right? So if it's something that you're really interested in doing, validate it for yourself. Tune into my message. No doubt about it. It's free of charge. It's not going to cost you anything. You don't need to get stock market courses. All you have to do is get some books, read about it. Hell, all the information, if you don't like reading, is online. Honestly, if you need to know what a stock is, Google stock, Google P/E ratio, Google how to read a balance sheet. Guys, you can find out all this information online. But I would highly recommend, Brian, I don't know how old you are, that also kind of plays into this. And I've told a lot of, I get hit with this question all the time. And the few things that I kind of want to know is, you know, are you comfortable? How much investment capital do you have to add to it? What age you are and what risk tolerance you have for the stock market. And I kind of help you find out what some of those things are, but I actually kind of rely on my community to be the best judge of how much tolerance or risk tolerance they can take on when they put their hard-earned dollars to work in the stock market. And I can get that with further dialogue with you, man, but I would say do both. That's the advice that I would give anybody, honestly. It sounds like a traditional IRA is pretty identical to a 401k. Is that right? No, not really. 401k is going to be fully taxable. My understanding, I don't know of any traditional IRA that provides matching like a 401k. Unfortunately, 401k is just as good as the company that is endorsing that suite of investment products for that employer that they are being paid by to provide you as an employee of that company investing advice or product, excuse me. Okay. So I don't necessarily look at 401k as being the same as a traditional. Not really, Brian. I don't think so. That's, you know, I always insist that if you do have a 401k or a TSP at work, keep it. Okay. You don't need to cash it out to fund an individual account. What I recommend is to do both. I really do. And right, wrong, or indifferent, if you guys can look at comparison analysis between the traditional and the Roth online, and you can do the figures calculatively. And honestly, they're both fairly similar. It really just kind of depends a lot on where you anticipate being in your life in the future. I just choose the Roth for the very simple reason that I explained to you guys. I like capping the tax bracket eventually in my life at 0. And if I never want to cash out of it, I like the idea that I can transfer it to my kids. I'll leave them a legacy because I really don't care about the money. I don't. So I got Sarah here. Lisa B had a question about what a self-directed IRA is. Oh, nice. Did I miss that, Sarah? I apologize. There was a rash there that went through really quick. Yeah, so a self-directed IRA is kind of the bread and butter of the independent investor channel. And I had to be referred to what a self-directed account is. And in essence, what a self-directed account is you take on the responsibility of all of the movements within that account. And a new investor is going to be like, okay, Ryan, you just scared me. I will never do that. But here is traditionally what happens when you go sit down with a financial planner and you say, I want to start a Roth IRA. Okay. They're going to sit you down and they're going to explain compounding interest. They're going to explain a few mutual funds that they're going to try to sell you, and they're going to put you into a Roth IRA. Okay. What they do not tell you is that they're going to take you and they're going to put you into a managed Roth IRA. Okay. Managed Roth IRA. Now, when they've taken you and put you into that managed bracket, you are now subject to all the fee structure along that spectrum. Okay. So you think that you're doing the good thing, which you are by taking the proactive steps of starting an individual retirement account. Okay. Let's say you start a Roth IRA. They're going to put you into the managed situation. And what that allows them to do is if you want to fund that account every single month, for example, they're going to charge you a certain percentage to take and fund that account, usually a little bit more than 5% every single month they're going to take. So if you are investing $100 a month, they're going to take $5 a month, $5 a month, $5 a month. That's a managed account. Furthermore, let's say you buy a mutual fund in that account, okay? Or you buy 4 mutual funds in that account, all right? And you want to do $25 per mutual fund. Guess what? You're going to now pay 5% for each one of those $25 blocks, $25 blocks, $25 blocks every single month. Okay. That's a managed account. All right. Managed. If you own single stock in your Roth IRA that is attached to a managed account, you're not going to pay a $7 entry fee. You're going to pay a $50 fee in a managed account to enter into single stock allocation in a managed account. All right. Remember this bracket. All right. Now, guys, this bracket that I talk about, I've done videos on this very thing when I talked about 43 pages of financial disclosure, financial fees that are assessed in this bracket of account. Now, there's no way that they're going to explain this 43 pages to you. Furthermore, they are not required to do so. All they're required to do is let you know to read the financial disclosure before you sign up for an account, before you invest one single dollar. Okay. If you're going to dividend reinvest, they're going to charge you for it. Okay. If you're going to dollar cost average, like I talked about, they're going to charge you for it, right? Everything is identified in that 43 pages along this spectrum in a managed account. Okay. In a managed account, you're going to get hit with annual account fees. Okay. They're going to charge you $100 for whatever reason, just because they can. They've told you that they can. All right. Self-directed account, you take this entire spectrum that I just explained to you, this entire spectrum, and it's gone. It's gone. It's all gone. Dollar cost averaging is free of charge. Okay. Dollar cost averaging. Dividend reinvestment is a setting within your self-directed account that you can go in there. And if you own Apple stock and you want to take those dividends and capital gains and you want to reinvest or buy more shares of Apple stock over your entire life, a managed account will charge you for that. A self-directed account will not charge you anything for that. Okay. Now, the real big kicker in a self-directed account that a lot of people talk about with me is the prospect of the commission on stock trades. Let's say if you want to buy the VOO or you want to buy the VTI like I'm recommending to you guys, there's probably going to be a preliminary entrance fee of $7, okay? And that's the difference in a self-directed account as opposed to a managed account. If you look at the broker fees on a managed account, guys, they're crazy. Like to buy single stock, it's crazy wild. I talk about the example all the time of my investment in Duke Energy. I paid $50 to enter the stock. I paid $300 to exit the stock because I made so much money on it that the money manager had to charge me some garbage fee because I made money on the investment. I was like, I took all the risk, man. Why am I paying you my capital gains out of my, and that's how it works in a managed, because it says in that 43-page document that they can do that. So you sit there and say, okay, well, what does all this mean, Ryan? You know, you're talking about 5%, you know, willy-nilly here, little there, little there. It doesn't make a big difference. And that's what the big misconception in the industry is, that those small trivial fees on an industry average 1 to 3% don't make that much of a difference over time. And that is the biggest misconception that people take when they go into a managed situation. They think it provides them some sort of strategic advantage. It does not. It does not in any form, fashion whatsoever. As a matter of fact, as a self-directed investor, you have all the advantages. Every dollar that you would ever pay under a managed situation to the brokerage house, you keep for yourself. You keep for yourself. Furthermore, those dollars are set in those accounts to allow themselves to compound and grow for you over time. Thank you for that question. It's my favorite topic. I stick with the channel. You're not going to get all the answers on a live feed on a Friday night, but I encourage you, if you have direct questions for me, hit me up in the Facebook group. I'm very accessible. I'll answer any questions that I have. I will help anybody. There's no doubt about it. And I do not care if you have zero experience in the stock market. There is no experience needed whatsoever to do this, because all you have to do is start the account, fund the account with an amount that you're comfortable with, and then understand the assets that we're going to put in that account to get you that diversified base in that account. And it's going to allow it to grow on autopilot. And if you don't want to look at it this is for Lisa. If you don't want to look at it for the rest of your life, then don't look at it. Look at it for when you retire, and you'll be amazed. You will be amazed that you ever came across the Independent Investor channel. And that, in essence, is the difference between a managed fund and a self-directed fund, okay? Self-directed fund, you have to be kind of careful of, because if you call any broker out there and you ask them to start a self-directed account, they're going to try to upsell you on a managed account, because a managed account is the only thing they benefit from. If you start a self-directed account, you're in charge. They don't benefit at all from that. So thank you so much, Sarah, for bringing that to my attention. Lisa, I hope that was a good enough explanation. I'm very good at breaking down information. If you didn't get it, no problem. Just hit me up in Facebook and I'll take care of you. I want to make sure that you understand this very fundamental premise. You do not have to understand what perfect stock to buy. You do not have to understand the perfect investment out there. You want to know why? Because it doesn't exist. It doesn't exist at all. What we try to do is put the most defensive, diversified assets in your account to give you the very best chance of getting that accumulated value as quickly as you can and as safely as you can going forward in your life. Thank you very much for the question. That was awesome. I got to scroll back down. I got a lot of questions here. Oh my gosh. Oh man. Yes, I got one of my favorite channels on here, and I've got Average Joe on here. I gave Average Joe a shout out last week, but I definitely want to give Marvin's on here from Financial Information, man. No doubt. One of my very favorites, man, from the very beginning. Actually, I think Marvin's one of those guys. He's the guy on the forum with the Financial Information. Anybody on this particular live feed, you got to make sure and kick over there. If you missed it last week, you got to kick over and support Dave with Average Joe, but also with the Financial Information. The Financial Information probably delivers the most in-depth stock review, does just a phenomenal job, and I've endorsed him ever since I watched the channel. Hard worker. very genuine approach, and I really appreciate it. So that I just scrolled down and saw you guys were on here. So very cool. It's awesome to have you. I do agree that not everyone has the opportunity to invest in the stock market. We are lucky to have the chance to invest in high quality stocks. Not only are we helping those companies grow, yeah, man, it's just, we're lucky, guys. You don't want to take the stuff for granted at all. And that's why I talk about investing being relative. Okay. I don't care what your background is. I don't care what your nationality is. I don't care what your religious beliefs are. I don't care. It's your personal decision. But if you have the fortitude at all to want to enhance your life at all with the small piece, financial is not going to give you spiritual health. It's not. It's not going to give you physical health. It's not going to give you, emotional health. Okay. Investing health is just that small piece of pie in your life that if you can get it right, and it's controllable, it really is. You can take these very simple steps and you can control this over here. And my point by that, and I appreciate the financial information. I appreciate Marvin backing me up on that, because a lot of people, guys, don't have that luxury. They don't. They really don't. Welcome to the channel. It's awesome to see you, man. Very cool. That's a channel right there that I would love to see with 50,000 subscribers. Financial information. AJ, I think we'll get there maybe in due time. I don't know. Maybe we'll be in the old folks home someday with 50,000 subscribers finally. I don't know. We'll see what happens. I know the people are out there. I just don't think people are coming through the channel yet, but all in good time. It's all good. I want to diversify VOO, VYM, and Berkshire B as a long-term. Yeah, so those are all really, really good. Berkshire B is a cornerstone in your portfolio. I would certainly throttle back. And if you wanted to do either one of the VOO or VYM, I prefer VOO to get your feet wet in the stock market if you are a beginning investor. Okay. So Sarah's giving Average Joe a shout out on the channel. That's very cool. We're trying to build a community, guys, here. And like I said, it's not going to happen overnight. It's really not. But definitely want to make an open door policy for anybody out there. I find all the time that people are so self-deprecating. And the first thing they want to say is, oh, I can't invest. I can't do that. I don't know anything about the stock market. And I contend that there's a lot of people out there that know way too much about the stock market. Those are the ones that are the most dangerous, because those are the ones that think that they can forecast or anticipate the stock market or certain stocks moving in a certain direction. And that's just not possible. It's not possible. You can do technical analysis, you can do fundamental analysis, and you can stack some of the chips on your side to give you a best educated guess as to where a stock is going to go. But that is all you have. That's all you have. And some of the very best money managers on Wall Street get this stuff wrong all the time. Right? So the very best thing that you can do is buy the very best account, buy the very best diversified assets to go ahead and grow your portfolio passively over time. That's the only way compounding is built over time anyway. All right. So let's go down. The last thing you do is ask a starving guy for half of their food to teach them to feed themselves. Yeah. Hey, that resonates with me, man. I was a commercial fisherman. I don't know if I've ever said that on the channel, but it's a lot of where my mentality comes from, because I used to commercial fish in Alaska, right? And to be successful as a fisherman, you have to prepare everything to move away from the dock and go into the unknown. You don't know. You don't know how good of a season, you don't know how bad of a season you're going to have. But I got so used to leaving the dock, and if I knew that I put in the hard work and I knew that I prepared and controlled everything that I could control, that we would actually have success, right? And I got that ingrained in my head, and a lot of people fall victim or fail in the stock market because they want that immediate gratification. They enter the stock market tomorrow and they want to see immediate returns, and it's not going to happen. Okay. I'm going to tell you right now, it's not going to happen. All right. And so that's where a lot of that kind of comes from. That's really cool you said that. But that's kind of where some of my mentality comes from. I don't mind putting money on a plane. I don't mind investing in an asset and having it adjust down, because I will have put myself into an asset that I can take into a downturn and still be proud to own, keep, hold, and maybe even invest more into it. But I do not want to second guess the asset after I've already invested in it, okay? Take a step back for a second and say, is this a stock or an ETF or an investment product that I'm willing to own for the rest of my life, right? And if you can answer that honestly for yourself, then you're ready to go ahead and devote dollars to that particular asset, okay? Mike Babcock hit me up. I wish my father received this info earlier. He is in a advised account. Monthly fees eat all his dividends. Trying to talk him into letting me take control of the account. Yeah, I tell you what, man, this is a scary thing approaching the older generation with this topic. He'll probably laugh you out of your chair if you say, hey, I've got some crazy YouTube guy talking about, you know, you're crazy by being an investor with a financial planner. I've been with four in my life. I know what I'm talking about. I've been there and done that, guys. And I can tell you, I've had a lot of financial planners justify through my subscriber base that it's okay, go with a managed account and you can justify the fees in that account by the dividends that you're paid. So in essence, it's okay that you're getting paid the fees or charged the fees. You're getting paid the 3% dividend over here. So the two are kind of a wash, and then you can keep the capital appreciation. That is the biggest piece of garbage advice that I've ever heard in my life. And I understand, you know, you can invest in a financial planner situation, invest $150,000, you know, $150,000, and someday end up with $450,000. And a lot of people would say, gosh, Ryan, that's great. It's almost triple, you know, it's tripled in value. That's good, right? And my thing is, look, in a self-directed account, that same $150,000 of contributions would have grown to over $1 million, right? Or $1.5 million. So you tell me what the more successful thing is. And my thing is I would like to liberate my money and take my chances going forward. I do not want to take the chance on a money manager that, guys, I'm going to say it, and this is a scary thing to say, but they don't provide you any strategic advantage at all, none. And you can tell your dad that. And tune them onto the channel. Have them reach out to me directly, man. I'd love to help. I don't know if I would recommend tweaking with a portfolio that's old. You know, he's got an established program, and that's good. But that doesn't mean that you can't change. You know, there is a new regime of investing moving through the ranks. It's that simple. And I honestly think that financial planning for individual investors is going to be like smoking. Honestly, it's going to be one of those things that when you do, you try to quit. And if you do it and you quit successfully, you're going to be so glad that you did. And you're going to look back and you're going to be like, I can't believe I ever did that. I can't believe it. So it's awesome because you guys can listen to a true testimonial of a guy that's been there and done that. And I look at the benefits now of, I'm making myself wealthy. There's no doubt about it. And I don't have any magic formula. I'm not going to tell you the magic stock to go buy. I'm not going to tell you that I know what direction the stock market is going to go, because it's impossible. What I can tell you is that you can control these aspects over here. And if you do these fundamental things first, then all that other stuff you're going to be prepared for, and you're going to be prepared in the correct manner. It's an awesome question. Thank you. No independent course for 1,000 then? Yeah, all the power to, hey, listen, I'm about compensation, and I actually made a section on Scribner's course, stock market course. I did it for him for free. He wanted to compensate me for it, man, which I thought was a phenomenal gesture. But I'd do anything to help that kid. I really would. I think the sky's the limit for him. I just need him to keep perspective, because I tell you what, you bestow that much success on a young kid, it's really hard to keep perspective, unless you've got your butt kicked a few times by life, a few times. That way you really, really appreciate it. Really appreciate it. And real appreciation is really hard to come by in this life. It's hard, it really is. When stuff tastes sweeter to you because, there was a time when you didn't have that stuff. Yeah. But no, there will be no $1,000 stock course from me. No way. I feel like I can provide this. It's no skin off my teeth to provide this information free of charge within my power. No doubt about it. And I know my stuff works. I know it works. I don't need to try to sell people on it. I've done videos on this, and I think the $1,000 that I would take from you, I don't need your money. You do. You need it. $1,000 could be a heck of a start. You know, if you invest $1,000, you may get some knowledge out of it. You may go halfway through the course and then throw the rest of it in the trash. And then where are we? What real tangible benefit are you getting out of that to provide yourself a strategic edge by dropping $1,000 into a vacuum only to have to make that up, right, to get back to zero and then start investing on the positive side of the house? I won't do it. I don't believe in it. I'm sorry. I just don't. That's pretty cool. Thanks for the comment, Marvin. You know where I'm coming from. I would. They have them in 13 ETFs, mutual funds, only 2 of which I like. I'm trying to figure out how to exit these positions in the best way and get them on the right track. Wish me luck. Michael, if you need help from me, let me know. That I'm pissed. I'm pissed for you. That's crazy. I've had the same thing happen to family. I know Golffish. He's on here as well. He's been a long-time subscriber of the channel, and I know I've went back and forth with Golffish. That's the comment right below you on that very thing. Investing in multiple mutual funds. You don't need multiple mutual funds. You don't. You just need one. You just need one ETF that covers the broad index, right? You don't need to go out there and buy everything under the sun. You don't. You need to put all your eggs, channel them into one diversified asset to work for you over time. That's all you need. You really do. That's really unfortunate, man. Really unfortunate. God, that's terrible. Let me try to cruise down here. I'm going to try to wrap this up, guys. I've been going for about an hour and 11 minutes. Sorry about the technical difficulties at the top of the show. Like I said, I'm building this business out of my garage. So you guys got to bear with me. Thank you so much for coming back to the group. I'm sorry we got a late start today, but I'm going to try to wrap up some of these questions. So Golffish hit me up. Can you do a video about Edward Jones' new managed account options? Seems to me it's the same garbage packaged in a new way. No doubt about it. So Golffish just hit me up, and that was the brokerage house I was with before I switched to Merrill Edge. They were coming out with a self-directed program. They had it betaed out of Canada, I believe, but they were still charging 1% for me to do all the work. So they're just trying to get your money. Guys, there's a reason why they have 1 trillion assets under management. Now, they've changed the lingo, and they've called it assets under care, okay? There are assets under management, and the financial institutions are trying to move away from that dialogue. And then you've got guys like me who are out there exploiting that dialogue, because that's exactly what it is. They're taking your money and they're keeping it under assets under management. That's how they get paid. That's how they pay for all their banquets and trophies and incentives and golf trips and dinners and celebration banquets and holiday banquets and everything else that's paid for in that 43-page disclosure, right, that I talked about. You guys are paying for it. You guys that are part of managed situations, you're the ones that are paying for it. And I'm proud to not be playing ball anymore. I will do a video on that. I will do that. I try not to bash them too much, but you can kind of see where some of my passion comes from. Lisa, you're welcome. You are welcome. If you need anything further, I know that's a lot to throw at somebody, but I'm speaking the truth. And I'm trying to break down that information as if I was a new investor. Unfortunately, a lot of new investors, man, they don't know where to go. And there's so much information out there. It's so hard to find a piece of information that really resonates, makes sense, and that is freaking right. It's right. And I want you to don't invest one dime until it makes sense to you, okay? So hit me up with your questions. I know you're not going to get it all through one Friday, live stream, but certainly join the Facebook group and we'll get you squared away. There's a lot of good folks on there helping people portfolio build 7 days a week, 24 hours a day, man. We're like 7-Eleven on the Facebook group, man. It's good stuff. Helping a lot of people, hopefully helping a lot. Financial information, thanks for the shout out. No problem. It's easy. You deserve it, man. You deserve it. You're a hardworking, sincere guy. Do anything to help you. No doubt about it. Thanks. Hope that helps, Lisa. You bet. Yep. My kid's 528 account my bank had me open is bleeding money. You're going to have to hit me up in the group on that, Sarah. That's interesting. I want to make sure it's not a 529. If it is a 528 account, I'm unfamiliar with that. You got me on that one. I have 529s for my kids, not 528s. So make sure that you're right on that. I want a little bit more clarity on what's going on there. I invest in banks. I don't do business with banks insofar as I don't pay them a dime. No way. I'm there to exploit your service. If you don't like it, I'll move to the next one. That's my opinion of banks. So yeah, hit me up in the Facebook group on that for further, Sarah. Avi hit me up. I work with a group of 20 sums, and I have pointed them all to your channel and do my best to inform them on the power of starting their self-directed Roth as soon as they are able. Thank you. Thank you. That's the only way that I can spread the word. Honestly, I had to get this off my chest. That's why I never really had to fumble with the decision of starting the Independent Investor channel. It's something I had to do. I had to do it. I had to do it. But the strength of this channel and the reason why it's actually starting to build really quick right now, I'm actually very encouraged. I just ripped right through the 3,000 level, and I think it's starting to compound a little bit. But I think the strength of my channel, I've looked, the analytics on my channel are actually quite well. Folks really tend to tune in and stay engaged in the message, which is a good thing because I don't put a lot of blah blah on my stuff. It is unedited, that's fine, but I don't want to water it down. I want the true me to come across because that's what I want to transcend in my message. But I really appreciate that referral, man. There's a lot of people out there who need help, no doubt. And I will help anybody within my power. The bigger the channel, the less available I'm going to be to do the one-on-one help, which I've been doing. I've kind of dissolved that away a little bit. But certainly all the answers are on the channel, all of them. They would never have to ask me a direct question. They could just tune into my catalog of videos, catch a couple per night. And they'd get 25 years of my experience all wrapped up into a catalog of videos that they can watch for free. Thank you, Avi. I appreciate that. That's awesome. Fish Tank Hacker, you're the best. I don't know if that's facetious or if it's true, but thank you. I'm just a regular guy, honestly. I don't do this for a living. I'm just providing a testimonial to hopefully empower individuals. I got Alexander. Hey, Ryan, I have a self-directed IRA with Merrill Edge, and so my trade fee is $6.95. How large should the position relative to that fee? That's a good question. I've actually hooked some people into Merrill Edge, and they've given a nice incentive group of free trades to get started. I think your question is regarding, like, should you buy every month or should you allow your dollar cost averaging allocation to build up a little bit? I would let it build up. I wouldn't get so wrapped around the axle on investing every month and incurring that $6.95 fee. I think it's worth it. But if you're doing 100 a month, allow it to build up every quarter. Do 400, do 500. And then when you feel like you've got a nice dip in the market, if it's gone down 4, 5, 6, 700 points, that's when I would step in and spend the $6.95 to make that injection into VTI, because $500 is going to buy you 4 shares of VTI. VOO is a little more; it's around 240 right now, and I don't want you guys to misconstrue the 240 ETF price with a $13 price share of GE. Okay, it's completely different. A share of the ETF VOO is going to buy you the entire index. And you guys don't want to underestimate the power of that, but I would allow your dollars to go ahead and grow a little bit in your money market account. And then when you want to make that strategic buy, go ahead and filter that money down into your passive ETF. I think that's the question you were asking. I get asked this all the time. It's a really good question, but don't think that you have to be restricted to doing dollar cost averaging every month. Not when you start. No way. What I'd like to see you do is if the $100 a month goes in there, and let's say you get a tax return and you get $1,200 back in your taxes, I'd love to see you inject $600 all at once into your retirement account. Then you can take those compounded dollars along with your lump sum payment, combine the two together and make one buy of stock or ETF in that account, okay? So don't think that you have to get stuck churning on that $695. I'd like you guys to keep it to as little as possible on those $695s. I understand it's kind of burdensome. I would have liked to have tried to help to get you some free trades entering that. And with a little bit of finagling, when you guys start the self-directed Roth IRA account, hit me up and get my referral because I've actually already talked to them, and we can usually hook you up with 100 free trades, to kind of get you started and set those accounts up. All right. Roth IRA allows you to contribute 55. Is that including trading fees? No, it's $5,500 of capital. The fees will get pulled out of the account. The $5,500 total is tracked. So it's not $5,500 minus fees. It's $5,500 that you can contribute. It'll track that within the account. Okay. You're a really cool dude. After seeing this, I'll stick around your channel, my man. That's awesome. Thank you. I'm a hardworking fella, no doubt about it. First commercial fishing, now military. Military's my active career. That's what puts bread on the table. This is a project to help people. That's it. That's it. This is stuff that I do. So it's easy to talk about. It's easy to try to share the message with others out there. It's very simple and it is absolutely scalable. You guys don't need to look at me and say, wow, here's a successful self-directed investor and say, this is something that I can't do. It's the complete opposite. It's absolutely something that you can do if you want to do it. All right. Ryan, since you've been in 4 managed accounts, my brother is in an established managed account. Is there any fees to close a managed account? Yes, there are. I was hit with those fees, Tim, but there was some incentive given in Merrill Edge. You guys kind of see the Merrill Edge commercials. They have 600 and then it's crossed out with a 900. They'll usually give you an incentive bonus to start that depending on the amount that you bring over to them. And if it's just a couple $100, it can be a wash and it can kind of help with some of those garbage exit fees that they're going to get you walking out the door, Tim. And that's the crappy part about it. But once you're done with them, you're done with them. And the idea that I talk with new investors all the time is getting that account that you'll never, ever walk away from, ever. Once you start the self-directed Roth, you'll never need another account the rest of your life, ever, ever. But I was there and I paid penalty every time I switched. I didn't know any better. I just didn't know any better. And that's a lot of part of the root as to why over, 25 years of investing, I've evolved to this opinion and can give it to people in such a frank manner. Don't forget to follow Ryan and his Facebook. Thank you. Yeah, please. I mean, it's going to benefit you more. I can't drop stuff on YouTube. I drop a bunch of articles. I keep it video free. I have an independent investor channel page, Facebook page, but the group is where all the resources are for portfolio building. Okay. And it's also where you can get your direct question answered by somebody who can help you. If you have an idea, kick over there and we'll get you taken care of. Join that. Yeah. Yeah. Dave needs to get over there, man. I've been waiting for him to kick over there. A Facebook group. I know as a channel creator, it's hard, man. We don't have a lot of time. I wish I just had more time. There's certain channels that I won't watch. There's certain channels that I want to watch and I don't. That's just the way of it. I only have so much time to give. And now I'm spending a lot of time on the Facebook group, actually, with my group. So great stream, great content as always. One of the best, most honest dudes on the tube. Cheers. Thank you, Avi. Appreciate that. Guys, I've been going an hour and 23 minutes. I do need to wrap it up. I'm going to take these last couple questions. Pay of house at 315 or invest in the stock market. Roth already maxed? Oh, that's a good question. I've got Bob Goldcat on here. Pay of house at 3.15 or invest in the market. Roth already maxed. I'd like to kind of understand a little bit more about what you mean, because it sounds like you're in the same situation as me. Once your Roth IRA is maxed, then you're going to want to start investing in your brokerage account long passive. Okay. I do long passive and short trades in my brokerage account because I have two Roth IRAs that are both maxed, and they're both maxed every year. So portfolio building is just that, Bob. It's just that a lot of my viewing audience is in that preliminary stage of getting budget cash account started and getting up to that $5,500 max. If you're maxed already, you certainly could add that additional layer on there of that brokerage account and do that. Or even depending on your age, start to think about some really, really good bond funds. I know Vanguard has B&D, which is better than your 3.15. So I don't know if you're talking about a certificate of deposit or a bond fund that you're in, or the 3.15. So hit me up in the Facebook group and give me a little more clarity on what you mean there, and I'll help you out. Bob, personally, I pay extra on my house. Oh, okay. You're talking about your actual house. Okay. Even though my rate is 3.75 and the market returns an average of 8, I've just never met a debt I liked. Okay. Thank you, AJ. Appreciate it. AJ. So Dave took care of you there. So my advice, quite simply to you, Bob, is to do both. Okay. I don't tend to mix equity in a home. I believe a home is an asset. It's probably a lot of people's biggest asset, to be honest with you. But I do not want to see you rush to pay off a house. I do not want to see you refinance. Refinancing is the worst thing. If you've owned your house for quite some time, you're on the latter 15 year side of the house where you actually are the beneficiary. A lot of people don't make it to that latter 15 years, from 15 to 30 years. So I want you to just continue to pay on schedule. If you can help yourself out and make one extra payment on your house, please do so. It will knock 8 years off of your mortgage. So a 30-year will turn into a 22-year. That'll help you immensely. But I certainly don't want to see you struggle to pay off a house at the expense of a Roth, or even in your case, to start that brokerage account and continue to invest on that side of the house. So thank you for that. What is your Facebook page link? I'm going to drop it in the description of this live feed. It is actually on the Independent Investor channel link over. It's the tab on the bottom of the channel page on YouTube if you kick over there, but I will make sure that you get that. Show your support, hit the button if you haven't already. Thank you. I appreciate that, but I split my expendable. Okay. Okay, guys, I'm going to wrap it up. I've been going an hour and a half. I've lost my voice. It's gone. I want to thank you guys so much for tuning in. I really wanted to be aggressive on answering every question, and I think we've done that tonight. Certainly, if there's something that you didn't get answered, or it was a partial answer from me, keep the discussion going in the Facebook group. I really appreciate it. We will go the nth degree. Don't think that you are going to become an investor overnight. You are very welcome, all. You are very welcome. You're very welcome. I'm glad to do it. I look forward to doing this every week. We will be doing this every Friday. Certainly tune in. There's no better thing to be doing than kind of talking and massaging over your financial health a little bit. I really appreciate the support, man. It's very cool. I'm humbled by it. And I'm glad to help, guys. So go ahead and kick over to the Facebook group and we'll continue some of the discussion. Thank you so much. Remember that evolving as an investor takes time, okay? You're not going to evolve as an investor overnight. Furthermore, nobody ever knows it all right? I'm evolving as an investor. I would ask you guys to go ahead and start that evolution for yourself in becoming an empowered investor, guys. Thank you so much for tuning in, and good luck in your investment future, guys. Thank you.